Two investors, same $10 a day, same 20 years. One built a portfolio spread carefully across 9 different industries. The other bet almost everything on the one stock everyone at work kept talking about, the one that felt too obvious to pass up. One of them still has a portfolio today. The other one doesn't, and it wasn't bad luck. It was math, the kind that was completely predictable in advance if anyone had bothered to check it. My name is EcoSticker, and I spend way too much time thinking about money, the hidden psychological traps of wealth building, and why just diversify is advice everyone gives and almost nobody actually knows how to execute. If you want the real framework, how many stocks you actually need, how much to put in each one, and how to spread them so one bad year doesn't take the whole thing down, hit subscribe and give this video a thumbs up if it ends up saving your portfolio from becoming a cautionary story instead of a retirement plan. Here's why just diversify isn't actually an answer. It sounds complete. It isn't. Diversify how much? Across how many companies? In what proportions? Most people nod along to the advice and then go build a portfolio that's either dangerously concentrated or so scattered it's basically an index fund with extra homework and none of the simplicity. Today we're fixing that with 3 specific questions and real numbers behind each one. Question 1. How many stocks do you actually need? This is the question almost everyone gets wrong in one direction or the other. Some people own 2 or 3 stocks because that's what felt manageable, or because they got excited about a couple of companies and never got around to adding more. Others try to track 50 because they read somewhere that more diversification is always strictly better and burn out within a year, checking dozens of tickers they barely remember buying. Here's what the actual research on this shows. Owning a single stock instead of a properly diversified portfolio adds an enormous amount of extra volatility to your results. Something in the range of doubling or tripling your normal year-to-year swings compared to the broader market. Where the overall market might move up or down somewhere around 15% in a typical year, a single stock portfolio can easily swing 30 or 40% in either direction over that same stretch. That's not a small effect. That's the difference between a rough year you barely notice and a genuinely dangerous one that changes your retirement timeline. As you add more stocks, that excess risk drops off quickly at first, then more slowly. Somewhere around 20 to 25 holdings, you've eliminated the large majority of the risk that diversification can actually remove. Something in the neighborhood of 80% of the excess volatility a single stock would carry. Push toward 100 holdings and you squeeze out a bit more, maybe another 5 to 10 percentage points of risk reduction. Push toward 400 holdings, essentially the entire market, and you're capturing almost all of the diversification benefit that exists to capture. But look at the shape of that curve. The improvement per additional stock gets smaller and smaller the further out you go. Going from 1 stock to 25 removes the overwhelming majority of the danger. Going from 25 to 400 removes only a sliver more. Past a certain point, you're not meaningfully reducing risk anymore. You're just adding companies to track for very little benefit, and very little benefit isn't nothing. But it has to be weighed against the actual cost of managing that many positions. So the honest answer sits in a range. Somewhere between 15 and 25 stocks gives you real, substantial diversification without turning into a second job. Enough spread to survive one company having a genuinely terrible year without it meaningfully denting your overall results. Few enough that you can actually explain what every position does and why you own it, which turns out to matter more than it sounds like it should. Question 2. How much goes into each one? Here's where a perfectly reasonable stock count still manages to wreck a portfolio, because people pick the right number of companies and then weight them unevenly, often without even realizing they're doing it. They add a little more to the company they feel most confident about, or the one that's had a great run lately, and suddenly 40% of the portfolio is sitting in one position while 19 others share what's left. The uncomfortable truth is this: you don't know in advance which of your 15 to 25 picks is going to be the standout performer, and neither does anyone else, including professionals with research teams, decades of experience, and direct access to company executives. If the pros with every resource available can't reliably call it in advance year after year, the honest move is to stop pretending you can either, no matter how confident any single pick happens to feel in the moment. That's why equal weighting is usually the right default. Split your contribution evenly across every position instead of loading up on your favorite pick or the one that's been performing well lately. If you're investing $10 a day, that's roughly $3,650 a year. Split across 20 positions, that's about $182 per company annually, or a bit over $15 a month into each one. Unglamorous, mechanical, and exactly the point. You're removing your own gut feeling from a decision your gut feeling is statistically bad at making, and you're doing it deliberately rather than by accident. Here's a scenario worth sitting with. Imagine two portfolios, both with the same 20 companies, both contributing the same total amount each year. Portfolio 1 splits contributions evenly. Portfolio 2 puts 30% into a single favorite pick and spreads the rest thin across the other 19. If that favorite pick has a spectacular decade, Portfolio 2 wins, sometimes by a lot. But if that same favorite pick has a genuinely bad decade, the kind that happens to real companies more often than anyone likes to admit, Portfolio 2 takes a disproportionate hit that the other 19 positions can't fully absorb. Equal weighting isn't about maximizing the upside of your best guess. It's about making sure your worst guess can't quietly take the whole portfolio down with it. Question 3. How spread out are they really? Here's the part that trips people up even after they've nailed the first two questions. You can own 20 different companies and still not be diversified at all if all 20 happen to sit in the same industry or in 2 or 3 closely related ones. Companies in the same sector tend to move together. They face the same interest rate environment, the same regulatory pressure, the same commodity costs, the same shifts in consumer behavior. When that sector turns, they don't fall one at a time while the others hold steady. They fall together, and a portfolio that looked diversified on paper suddenly behaves like a single concentrated bet on one part of the economy. Look at how a typical broad market index actually breaks down by sector, and you'll find one sector alone often makes up close to 40% of the entire thing. That's meant to be the boring, safe, diversified benchmark that people point to as the responsible default, and it's still carrying an enormous concentration in one part of the economy without most people ever noticing. A reasonable rule here is to cap any single sector at around 25% of your total portfolio, and to genuinely try to spread your picks across companies that don't overlap much in what they actually do. If you can't find a solid company in a given sector at a reasonable price, the right move is to skip that sector for now, rather than force a mediocre pick just to check a box on a spreadsheet. Sector diversification is never worth overpaying for, and an empty slot is better than a bad company filling it. Building the actual portfolio. So here's how this comes together in practice. Set your criteria in writing before you look at a single company. Solid balance sheets that don't carry alarming levels of debt. A dividend that's actually growing meaningfully over time rather than sitting flat or creeping up by fractions of a cent. And a payout ratio low enough that the dividend has real room to keep growing even through a rough earnings year, rather than one that's already stretched to its limit. From there, you're looking across a wide range of industries for companies that fit that profile. A home improvement retailer with decades of steady dividend increases behind it. A regional lending company serving a stable, recession-resistant customer base that doesn't disappear when the broader economy wobbles. A utility provider, the kind of business people need regardless of what's happening anywhere else in the economy. An industrial company making unglamorous products that quietly show up in everyday life without anyone thinking twice about them. A healthcare-adjacent company with a long track record of steady, predictable demand. A software company serving a niche most people have never heard of, but that every business in that niche genuinely depends on to operate. A materials company making the packaging or components sitting quietly inside products people buy every single week without noticing the name behind them. A real estate company owning the physical infrastructure behind an industry most people never think about directly. Warehouses, storage, distribution space. Spread across 9 or so distinct sectors like that, with 2 or 3 companies in most of them, your largest single sector exposure lands well under that 25% cap, often closer to 12 or 13%. That's the actual output of the 3-question framework. Enough stocks for real diversification, evenly weighted so no single pick can quietly dominate your results, and spread widely enough across industries that one bad sector doesn't take the whole portfolio down with it at the same time. What $10 a day actually becomes. Now let's look at what this actually produces over time, because the long horizon math here is where the framework proves its worth. A portfolio built this way, combining a modest starting dividend yield with a strong annual dividend growth rate and reasonable long-term share price appreciation, compounds in a way that looks unremarkable early and increasingly dramatic later. By year 10, contributing $10 a day the whole way, you'd have put in roughly $36,500 yourself. The account, growing through both price appreciation and reinvested dividends, lands somewhere in the neighborhood of $65,000 to $70,000. Already the portfolio has added more than you personally contributed, quietly, without any single dramatic year driving it. By year 20, your own contributions total around $73,000. The account itself is likely sitting somewhere over $300,000. The growth isn't linear anymore. It's compounding on itself, dividends buying more shares, those shares generating more dividends, in a loop that gets faster the longer it's allowed to run uninterrupted. By year 30, total contributions land around $109,500. The portfolio itself, at reasonable long-term assumptions, is projected to be worth well over $1 million. And here's the number that actually matters most day to day. At that point, the dividend income alone, without selling a single share, can realistically be generating somewhere in the range of $5,000 a month. A mortgage payment, a car payment, groceries, covered entirely by something built $10 at a time, on a schedule, without a single dramatic decision required along the way. Why this actually works. Here's the part that matters more than any specific dollar figure, because markets shift and exact numbers will always move, depending on which decades you happen to live through. What actually makes this work isn't picking winners, it's the structure underneath the picks. Enough companies to survive any single one having a terrible year, weighted evenly so no single bet can quietly take over your results, and spread across enough industries that one bad sector doesn't sink the whole thing at once. Go back to those two investors from the start. Same $10 a day, same 20 years, same access to the same information. One followed a structure that didn't depend on being right about any single company. The other made one concentrated bet on the stock everyone was excited about, and when that company had its bad year, there was nothing else in the portfolio to absorb it. The gap between them wasn't intelligence, and it wasn't luck either. It was the presence or absence of a framework that didn't require either one of them to be right about the future. So here's where you actually stand now. You know the honest answer to how many stocks you need, somewhere between 15 and 25, enough for real protection without turning into an unmanageable second job. You know why equal weighting beats picking favorites, because nobody, including professionals, can reliably call which position will outperform, and betting otherwise just concentrates your risk instead of your returns. You know why sector spread matters even when your stock count looks fine on paper, and what the actual cap should look like to avoid quietly duplicating the same bet 20 times over. And you know what a portfolio built this way, unglamorous and mechanical, is actually capable of producing over a real multi-decade timeline. You don't need a finance degree to start this. You don't need to correctly predict which single company is going to be the next big winner, and you don't need to feel confident about any individual pick for the framework to actually work. You need a framework applied consistently and the patience to let compounding do what it does over years that will often feel like nothing is happening at all. That's the entire mechanism. Everything after that is just time and structure, working together long after the excitement of picking any single stock has completely worn off.